So hi guys, welcome back. Today we're going to be looking at Bristol Myers-Squibb and whether this company is a good value play or a comeback play in the current stock market. So BMY, which is the ticker symbol of Bristol Myers-Squibb, is a dirt cheap stock as of right now, and it's trading only 8 times future earnings with a dividend yield of more than 3.2%, which makes it a pretty attractive buy for investors looking at it from the outside point of view. So today we're going to be looking at the future outlook of the company, the financials of the company, and the technical analysis of the company. We're going to be doing a stock analysis on this stock. So just before we begin, a little bit about Bristol Myers-Squibb. It's an American pharmaceutical company. It manufactures prescription pharmaceuticals and has biologics in several therapeutic areas, including cancer, HIV and AIDS, cardiovascular disease, diabetes, hepatitis, arthritis, and other psychiatric disorders. So Berkshire Hathaway, which is a company of the investor Warren Buffett, has first bought shares in the third quarter of 2020, and they actually increased their holdings in Bristol Myers-Squibb in quarter 4, which is a good outlook as he has had pretty good investing success over the last 20, 30, 40, 50 years. Analysts who've been looking at this company project future growth of more than 21% over the next 5 years, with its biggest drugs as of right now being the blood thinner Eliquis, or Opdivo and Yervoy, and I'll be talking more about the drugs such as Zeposia and Reblozyl later on when we're looking at the drugs compared to its competitors. So in their fourth quarter, or February 4th, 2021, Bristol Myers surprised investors with their beating of the quarter earnings expectations. They posted their earnings surprise was more than 6.57% higher than expected. It's expected that the company would post earnings of $1.49 share when it actually produced earnings of $1.63, which gave a good surprise for investors. Which means over the last 4 quarters, the company has beat its earnings per share estimates all 4 times, which is good for the future outlook. They also posted revenue of $11 billion, which beat the estimate of by more than 4.5%, and this is much higher than compared to the last year's revenue of $8 billion. So it shows that the company has also beat revenues estimates 4 times over the last 4 quarters. So basically they're beating earnings, they're beating revenue over the last year or so, which is good, and it has good positive outlook for the company. So in early August, Bristol Myers had a partnership with Pfizer, and they won a patent fight over the blood thinner Eliquis. During the summer, the Bristol Myers-Squibb has also approved its partnered drug Reblozyl with the company Acceleron Pharma. This drug can be used to treat patients with transfusion-dependent myelodysplastic syndromes or beta thalassemia. They've also launched a drug called Zeposia. This has recently gained European approval back in May, and it's the first drug of its kind that does not require observation for side effects following the first dose, which puts it ahead of competitors. These are the main 4 drugs that will be pushing this company's growth over the next 5 years before the patents expire, and once again the company has to invent new drugs. So the future growth of Bristol Myers-Squibb, the stock price is currently at $61, and this trades below the Simply Wall Street analyst expectation of $150 as fair value estimate. It's more than 50% undervalued based on their analysis. But even barring that, most analysts have come to agree that the fair value estimate of Bristol Myers-Squibb is between $73 and $75, which you get by taking the current earnings per share and multiplying it by its PE ratio. So depending on how conservative you are, it averages out between $70 and $80, which is actually more than $15 up from where the stock is as of right now, which is a pretty solid near-term growth that you're looking at if you do buy the company. The company is also expected to become profitable after their high spending in 2020, which caused them to make a net loss. This is expected to occur by late of 2021, so it's not too worrying for the company or its shareholders, as 1 year of unprofitability is not too bad, especially given that they're beating their earnings and revenue estimates, so it's not too much of a worry looking from an investing point of view. Its earnings growth is set to grow at 37% next year, which beats both the market and the industry, and their revenue is set to grow at more than 10% per year, which is less in terms of growth, which means that the company's return on equity and return on assets will increase, but it also means that it will outperform the industry but not the market. But overall, it has pretty good future term growth in that regard. The next thing we'll be looking at is the financials of the company. One trend you'll see over time is that the company's financials have been pretty good over the last between 2010 to 2019. However, in 2020, they really struggled. As I mentioned, they ended up with a net loss. So its earnings per share started off at $2, had a dip by about 2014, but between 2014 and 2019, consistently making step upwards, so that's a good sign. Dividend consistently increasing over the last 10 years, shows good future outlook for the dividend and shows the company is paying dividend at a healthy rate. Same can be said about book value per share. The value of the company has been incrementally increasing over the last 10 years or so, which is solid once again. Its operating cash flow, cap spending, and free cash flow have all increased over the last 10 years. Basically, more money is coming into the company, more money is going out of the company, and more money is actually staying as free cash flow inside the company. All very good signs for the future outlook of the company. Basically saying that the company is becoming more profitable and is spending more to improve the company while still increasing its profits. Great sign for this company. The net margin has fluctuated between 10 and 20% over the last between 2010 and 2019 again, which is pretty solid net margin, especially for a capital intensive business such as like inventing new drugs and creating new therapies, which is pretty solid for this company. So net margin still pretty good. Return on equity once again fluctuating between 10 and 20%, a little bit on the low side, but we have had years where the return on equity is more than 30 or 40%, which is once again decent return on equity, not too great, not too bad. Its interest coverage was very good actually before COVID hit, with its interest coverage fluctuating. Before it was 33 years, they took in slightly more debt, so it dropped down to 9 years, which is still a lot of time to pay off their interest. Once again, tying into my point about unprofitability, because of their pretty healthy interest coverage, it didn't matter if the company was unprofitable for 1 year, so it's not something to be worried about too much. Its debt to equity, however, is something that's a major risk for this company. Debt to equity is 1.3, which basically means that they have more debt in the company than shareholders' equity, which is a worrying sign for this business. So that's a major risk or a major flaw that this company has. So the next thing we'll be looking at is the technical analysis. You can see the stock price hasn't actually moved too far. Started 2020 at about $58, ended 2020 at about $66, and then since then it has come down all the way to $60. As you can see, the stock price has kind of been fluctuating between the red and the green lines, and it's actually trading at the 200-day simple moving average, with the 50 and 20-day simple moving average above that as well. So I would say this is a good time to buy. As you can see, every time I hit the red line, it did go up a good solid 10, 12, 15%, depending on where you bought it at. So it is a pretty good time to buy as of right now. As we mentioned, the financials are pretty good and the future growth of this company is pretty good as well. So I'll give a fair value estimate at the current price, $60.47, which is a good entry price for this company. So some final words. This Bristol Myers-Squibb is a cheap stock, trading only 8 times future earnings, has good growth potential with the 4 major drugs that it's bringing into the market. It has a pretty good dividend yield of 3.2%, and I believe it's one of the optimal value stock positions, as the company has fallen out of favor, trading at a cheap price, but still has good future outlook. However, there are major risks for it. Some of its drugs patents are running out, that they'll be out of order by between 2021 and 2022, and they have much larger, faster growing competitors such as Merck also coming in, taking out, growing really fast, which is a threat for this company. However, one upside is that the company has recently continuously beat its earnings and revenue growth, shows good future outlook for this company, and they have new deals with other companies such as I mentioned previously, Pfizer, which is bringing more drugs into the market, both through partnership and through their pipeline system. So if you do choose to invest, make sure to do your own due diligence, and thanks for watching. Bye.